This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Tuesday, July the 22nd, 2014. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly, but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing, or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss the key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month updates the macro developments. Therefore, the slides this morning will focus on our other three report areas of the GMT report: the global risk, regional, and U.S. economic developments. As I often do, I'd like to tie them together into a general discussion. I want to focus on what I see to be potentially one of the biggest mergers and acquisition errors occur within the next 18 months to 2 years that we may have never seen or witnessed before. I'd like to discuss this looming M&A wave or what I would call the greatest potential debt for equity swap in history. I'd like to do this with how this wave has been set up. It's been a long time building and the three stages of its evolution. I'd like to talk about the stock buybacks to the M&A melt-up, how you see that unfolding, and some accelerating examples, and the debt implosion and the great revaluation that I see coming with this. The great M&A wave I see was set in motion with the removal of the U.S. from a sound money system in March 1968 with the passage of the Gold Reserve Requirements Elimination Act. From that point, in accelerating fashion, credit creation in the U.S. began growing geometrically. It was slow at first, but steadily gained momentum after President Richard Nixon removed the U.S. completely from the gold standard in August of 1971. As credit increased, so did the U.S. current account deficit, as the U.S. steadily consumed more and more than it produced and easily financed it with debt borrowed from abroad and from the public. With the continuous expansion of the money supply, inflation, even knowing that it is a manipulated measurement, still accelerated significantly, eventually lowering standards of real disposable income as the wealth-producing engine of the U.S. was effectively gutted by debt payments. What I see as stage one ended with the dot-com bubble implosion. Up until then, the wealth-generating engine in the U.S., though crippled, was still operating, as evidenced by the computer communications revolution in the form of the arrival of the Internet. After the dot-com bubble implosion, we witnessed heavier uses of financial repression to keep credit creation growing by effectively penalizing savers. Additionally, 54,000 manufacturing facilities left America as the wealth creation engine was mothballed as easy credit to finance consumption took over. The capitalist system is about profits, what we call savings, being reinvested into productive assets. What emerged from here was the economy which grew based on credit and the use of that credit for consumption. Consumption subtracts from savings and investment growth, therefore steadily slowed as a consequence. Each crisis after the dot-com implosion has required increasingly heavier doses of negative real rates until quantitative easing in its various incarnations became a drug. Price discovery became opaque, and the mispricing of risk became a consequence. Securitization products within the emerging shadow banking system dominated the creation of credit through endless esoteric instruments. Financial engineering began to become standard practice for corporations with off-balance sheet special purpose entities and games of contingent liability accounting. This game came to another abrupt bump in the road with the 2008 financial crisis. This, unfortunately, didn't stop the relentless credit creation game, as the government became a much bigger part of the economy in an effort to keep the 70% consumption engine going. As we talked this morning, we have reached the point where 1/3 of U.S. GDP, according to a study by Bloomberg, is now going to pay interest and principal on loans. Debt saturation is a reality with wealth creation on very shaky ground. We are quickly reaching the point of unsustainability of credit growth due to insufficient collateral to secure new debt, remembering that money can only come into existence by creating debt. Not to be slowed, the government has therefore quickly looked the other way as rehypothecation entered the lexicon, where collateral could be pledged multiple times so as to keep this credit engine from stalling. Credit growth is presently really only coming from student and auto loan growth. This is a serious problem, especially when we see that auto loans are increasingly subprime loans to keep this going. Student loans are also realistically subprime loans, since the vast majority of students will not find jobs that pay a sufficient wage to pay these loans and yet tackle the financial hurdles of mortgages and family, etc. It is a bomb that is already going off but is being ignored until simply the next crisis erupts. Presently, the shadow banking system is gluing all this together with the old game of borrowing short and lending long, a game that quickly implodes when trust and confidence, for whatever reason, drops or changes. The short-term borrowing today is all based on the use of government repos as collateral, with games such as collateral transformations being used to keep the old AAA quality charade once again working. Obviously, this game can only go on so long before something breaks. I personally believe the central banks are well aware of this, and is one of the reasons the Federal Reserve in Q2 increased reverse repos to just short of $300 billion. The Fed wants firepower when this inevitable correction comes. I personally believe the Federal Reserve actually wants the correction, but they want it to be controlled. They likely have it targeted to be no more than 10 to 15%, enough to scare the market, but not enough to damage the underlying collateral values, which would cascade quickly out of control. There are many reasons why they now want a correction, but the biggest is to create a rotation into the bond market. A rotation that in 2008 resulted in negative rates on T-bills simply out of fear. With 75 million baby boomers retiring at $10,000 per day, there is a massive need for increased government debt at rates that can be financed. A bond rotation would both drive up collateral values, critically important to pensions and insurance companies, but also lower bond yields, critically important to the government. This would be a perfect intermediate-term outcome for the government. As part of the plan, the government has orchestrated, in my opinion, a massive run-up in the stock market through tax incentives for corporations to buy back their shares. This has lowered the yield value of equities and made poor-yielding bonds look relatively attractive. It is all relative when you are a fund manager that is paid to be fully invested in either stocks or bonds. As I mentioned, the government and the Federal Reserve are prepared for the correction with many new tools. Some of these tools the public is going to be shocked at. Tools which I've been steadily outlining in our site, the Financial Repression Authority. Tools which will transfer more wealth from the private sector to the government. What I believe is underway, however, is a much longer-term strategy, a strategy that uses all the elements of macroprudential policy or financial repression to keep the state funded. I mentioned earlier and have written separately about the $2 trillion buyback tax ruse currently underway in the stock market. This has allowed the S&P 500 corporations to buy back their shares thanks to the government tax policy. They simply can't buy back their shares fast enough in case the government potentially closes this window. As the government politicians point to the stock market as a sure sign that the recovery efforts are sound, many realize that all traditional measures of market valuation have simply been thrown out the window. They're not working. Beginning now and accelerating through the coming correction, the next few years, as I said earlier, should see a deal-making frenzy, the likes of which we've never potentially seen before, eclipsing the excess of the previous two cycles. This is likely on the surface at least on the surface for the following reasons. First, when compared to other deal frenzies, the real cost of debt this cycle is lower. Second, profit margins are, despite the first quarter, still at very high levels and are widely expected to stay there. This is not a bad combination for a deal maker, but it is the third reason that influences many of these analysts. The economy, despite its being in year 6 of an economic recovery, to them still looks in many ways like quite a young economy. There are massive reserves of labor in the official unemployment, plus they see room for perhaps a 2% increase in labor participation rates as discouraged workers potentially get drawn into the workforce by steady growth in the economy. They also see lots of room for a pickup in capital spending that has been uniquely low in this recovery. The very disappointment in the rate of recovery thus becomes a virtue for deal making. Additionally, previous upswings in deals tended to occur at market peaks like 2000 and 2007, which in complete contrast to today were old economic cycles already showing the wrinkles. Worse than being in full swing, they were usually way over capacity. Thus, 2000 was helped along by the bubble in growth stocks to over 60 times earnings, allowing companies like Cisco, possibly correctly, to believe that they were dealing with a near zero cost of capital and making deal after deal for their massively overpriced stock. Having said that, I believe the real reasons is the growth motivations for the corporations. They cannot achieve sufficient organic growth presently. That's clear on all top-line kinds of reporting that's going on. They have highly valued stock as currency to buy other corporations where accretive earnings are possible. A correction in the market will likely impact the emerging markets harder, as it did last summer, and will make these low-cost providers even more attractive to these takeover corporations. The debt taken on to buy back shares could be loaded on the balance sheet of the acquisitions as standard private equity deals have a proven track record of doing. Corporations could then reissue their stock, which they have just bought back thanks to the government tax incentives, for a stock-only mergers and acquisition, no doubt with further tax advantages. Many corporations will likely try to move out of the U.S. for even further tax reasons with their acquisitions, which will lead the U.S. government to create more incentives for them to stay, and we're already starting to see that appearing in the press. This potentially is one of the biggest corporate tax grabs in history, which the government must assist in if it has any hope of securing its funding requirements going forward. We already have significant M&A activity underway, as I said, and this is evidenced by such recent high-profile examples as Microsoft's takeover of Nokia and announcing here this week 18,000 people now to be cut in the combined operation, GE's fight and takeover of Alstom in France, and Rupert Murdoch's now running hard and attempting to take over Time Warner, and there's others. They're all interesting examples of what is to come, but let me focus on Rupert Murdoch's $80 billion attempt to take over Time Warner. I think it's telling. With Comcast's upcoming purchase of Time Warner Cable and AT&T's acquisition of DirecTV, two dominant broadband providers will control two dominant television platforms. This fear, mingled with concern about Google, Apple, Amazon, and Facebook's efforts to expand their television and movie offerings and divert some of the television's $65 billion advertising dollars, is in play here. But if Murdoch could acquire Time Warner products like HBO, which without ads generates close to $2 billion of income, Warner Brothers Film and top-ranked television studios, and cable networks that produce $3.5 billion of income, then he would regain considerable leverage for content. Two other impulses drive Murdoch's urge to merge, starting with that overused word synergy. His team estimates that consolidating News Corp and Time Warner's marketing, sales, finance, and leadership would save an estimated $1 billion at the two companies. The other impulse driving Murdoch's is one common to corporations, but actually rarely uttered publicly: to take the risk out of capitalism. Let me repeat that: to take the risk out of capitalism. Ted Turner and Rupert Murdoch intensely dislike each other, but on this point the two agree. Ted Turner once described his business philosophy as, quote, "You need to control everything. You need to be like Rockefeller with Standard Oil. He had the oil fields, and he had the filling stations, and he had the pipelines, and the trucks, and everything to get the gas to the stations. And they broke him up as a monopoly." He smiled, and then he added, in this quote, "The game is over when they break you up. But in the meantime, you play to win, and you know you've won the game when the government stops you." This is about monopolies, the Sherman Act, and getting around it and using regulatories to forbearance to allow you to operate for a protracted period of time. And the government is steadily capitulating in this regard. I mean, it says it all. Yes, the M&A wave is going to be about synergistic levels of existing talent. It's going to be about significant removal of staff duplication because of advancements in technology networking. But most importantly, it's risk removal. It's about market share and the better margins that come from having a larger market share. You may not be able to increase the top line. You can't further financial engineer the bottom line, but you can do something with market share and therefore margins by takeovers, and that's how you leverage your earnings. It's about using regulatory protection to create that franchise, a more profitable franchise. That's what it's going to be about. To the government, it's about the perceived tax revenues to pay for, one, imploding municipal problems like Detroit, Flint, Puerto Rico, and a wave more to come. It's about the approximately $5 trillion underfunded pension problems at all levels of government and corporations, with already low yields and no respite in front of them for increasing yields to get anywhere close to the 6 and 7, 8% that they were planned on. Additionally, we got an $84 trillion unfunded U.S. Social Security and Medicare entitlement program. In my opinion, this is going to be some really interesting times going forward, which may get very, very ugly. What we have here is effectively the biggest debt for equity swap in history that could unfold. The banks and corporations, by going through this, are going to end up with the assets. The public and the government, through regulatory arbitrage, is going to end up with the liabilities. And Mr. Global is going to end up with the net worth and the equity. Just watch how this unfolds. In conclusion, thank you for listening, and I hope that 2014 will be an outstanding investment year for you. Always take the advice of a professional investment advisor. And until next time, all the best.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.